Is value investing a thing of the past, or is it still in practice by investors worldwide? Or are you curious about buying low and selling high? One way or another, in today's video, we've compiled everything you need to know about value investing. Before we move on, make sure you press the like and subscribe button so that you don't miss out on anything related to passive income and stock market investing. Welcome to 5-Star Finance, the place where we teach you how to achieve financial freedom. Value investing was popularized by Ben Graham, which truly means buying a stock below its value. But keeping in view the competitive and volatile nature of today's market, is it still in practice, or is everything coming out of mere speculation? Can we still find businesses on sale at all? Value investing may not be as famous today as it was a few years ago, but we can use some principles and techniques which can help us in today's world. What exactly is value investing? To put it simply, value investing is the art of buying stocks or businesses at a discounted price. In other words, it means to buy dollars for cents. Developed and introduced by Ben Graham, value investing became extremely popular among the investors of that time. Ben also wrote a book known as The Security Analysis, which is considered the Bible of value investing. What Ben Graham did is he looked at the financial integrity of a company's business to see if the depression was pricing the stock improperly. He always tried to buy stocks below their actual value. Not to forget that when Ben developed this strategy, that was the Depression era, the era which is considered the dark era for stock market investors. During that period, most businesses lost their value and began selling at a far lower price than their actual value. Ben Graham developed very specific monetary criteria that allowed investors to identify a business that had a higher value than its actual price. Criteria for value investing. Ben Graham developed specific criteria which allowed investors to decide which stocks they were aiming for. Firstly, Graham was also looking for stocks that had a B or higher S&P rating. Moreover, another important pillar of his investing strategy was that he always favored outfits with a low debt ratio of 1.1. He wanted bargain prices. He looked for companies that had a PE ratio of 9 or lower. That also means that he wanted businesses with prices accounting for 1/9 of their earnings. He also looked for stocks that were already paying dividends, which means cash was coming out of them, and he was looking for companies that were so underpriced that you could buy them with the cash in their banks minus their debts. If Graham was buying the entire company, it was like if he stopped the company dead, took out their cash and paid for their debt, then he would have what he paid for the company. That also means that he paid nothing to the company. The businesses were so trapped during the Depression that they were left with no options. When other investors would also uncover the intrinsic values of these stocks and try to jump on the bandwagon, the value of these businesses would rise back and that would put them out of business. So what Graham played was that he would always get those companies before anyone could set an eye on them. He called these businesses cigar butts because some of them didn't work out. They were simply super cheap, and they were cheap for a reason which would eventually put you out of business. So it was not like every day is sunny and full of profits. To make up for that, he would buy a couple hundred of these cigar butts. You get the idea, right? If A doesn't work out, you always have something to fall back on. And of course, during the Depression and World War II, there were companies like these all over the place. Low risks. Another important principle that Ben Graham employed in his investing practice was that he didn't like taking a lot of risks. He always looked at what the liquidation value of the business would be. Did you watch that Hollywood movie, Pretty Woman, in which the leading character buys companies when they're in a state of turmoil? He buys them below their liquidation value and for a cheap price sells them off in pieces and takes all the profit. Now that is Graham's thinking in a nutshell. The problem with this strategy is that a lot of people can start hating you. For example, the legendary investor Warren Buffett employed this strategy once in his life when he bought a company for a cheap price in Nebraska. He was following Graham's path, and eventually, he sold off all pieces of that company. What this created was hate in the hearts of people for the name Warren Buffett because a lot of people lost their jobs, and Warren never did that again in his life. So you need to take a look at the way things were working during the Depression and how they're working now. The truth behind value investing. Firstly, we need to understand that times have changed. What was true for World War II and the Depression era cannot be true for 2022. No doubt that some investors still use the principles described by Ben Graham, but in today's world, it is also known as zombie investing. The word zombie describes that the companies required for value investing are very rare. Now, it is important to note that Buffett took this practice to a whole new level. No doubt he is a staunch believer in the value-based investing model. He follows the Graham school of investing. He looks for securities with prices unjustifiably below their intrinsic worth. But Warren's partner Charlie Munger persuaded him to step away from that cheap buying strategy and instead look for companies with increasingly positive potential, the potential to grow. Understanding the value of the business. In the absence of an economic recession, it is very hard to find a company that is selling below its actual worth. For that purpose, investors need to understand the value of a business. That's the critical change in the Graham school of investing because Graham didn't care that much about whether the business was performing well and what was going on with its balance sheet. Graham just looked at the numbers, whereas Buffett and Munger look at the company as a business. No doubt Buffett and Munger built on the principles developed by Graham, but they didn't act like sheep who has to do everything its master demands. They changed the principles that were in harmony with today's market so that they could achieve better returns and bigger profits. You've got to be patient with value investing today. As Buffett puts it, you need to look for wonderful businesses, not just dead businesses that you will sell someday in hope of earning some big returns. You've got to make a list of really wonderful businesses that you think you know and understand well, and then be patient. In today's economic conditions, especially with inflation crossing 7%, value investing demands the understanding of the 6 stock categories that are each different to analyze. Make sure you refer to the free ebook in the comment section below for a successful journey in investing. So what do you think about value investing? Is it yielding the profits at the same scale today that it was some 70 or 80 years ago? How do you plan to follow the Ben Graham School of Business? Let us know in the comment section below. Subscribe and turn on notifications. Check out this video we handpicked for you, and we'll see you in the next one.